Next up, we have Russel Pillemer, Chief Executive Officer at Pengana. Russell co-founded Pengana in 2003 and also has a Centric connection. Was previously chairman at Centric Wealth and a principal at Turnbull Pillemer Capital.
Okay, great. Hi, everyone. Thanks for being here today and taking the time to listen to me. There we go. So I'm here today to talk about investing in global private markets, being private equity and private credit. So the things that we want to get through, and I think I've got 25 minutes. Okay. So having a bit of a recap on private equity, global private equity, having a recap on global private credit, why are these asset classes so beneficial in portfolios? Then talk about how you actually implement them in your portfolio, and then pose some questions for you to consider when evaluating these asset classes. So let's start with global PE. So what's in the bucket? Now, I think this is a confusing topic for a lot of people, and when you read the press, they're all over the place about this. So at the small end of the market, private equity can be, seed capital, angel capital, small bits of investment in a very risky startup. At the higher end of the market, it can be investments into large cap or mega cap growth equity type businesses, like if you put your money into something like a SpaceX, all right? And in the middle of this all is buyouts, which are generally sort of mid-market buyouts, which is our sweet spot, which we think is the best part of the market. So a mid-market buyout, companies that might be valued at, say, $500 million to a couple of $1 billion, and they're doing management buyouts, leverage buyouts, so they use leverage in their acquisitions. And we like this because the mere fact that you use leverage means that your business has to be a nice, stable business. So we think this is a sweet spot in the market. We think this is where the best risk-return trade-offs exist. It can be a significant enhancement to your portfolio. So I think the statistics or the evidence will show that over long periods of time, private equity, at least this mid-market private equity, significantly outperforms listed equities, and it does so with low volatility. Now, we can have a chat later on about whether that's real volatility or just pseudo volatility, because things aren't being valued, on a day-to-day basis. But I think for all intents and purposes, it has lower volatility. But then finally, to consider, there are a lot of barriers to entry, and it's hard to actually implement these strategies into your portfolio, certainly for regular type of investors. So, not institutional investors or family offices or very wealthy investors, but, the ordinary type of investors that probably most of us in this room have. We'll talk a little bit about that later on. So manager selection, I heard Kieran mention this topic as well. Manager selection is absolutely key when it comes to private equity. If you were investing in listed equity managers, the difference between the top quartile and the bottom quartile managers are maybe a couple of percent. When you do it in private equity, you can see this over 20 years. The top quartile outperforms the bottom quartile by 15+%. So you really got to get this right, and it's very difficult to get this right because do you have the ability to identify who these managers are, and B, even if you do identify them, are they willing to accept your check? And we'll touch on that a little bit later as well. So why does global PE outperform? So the first thing is there is an illiquidity premium. So the mere fact that you're investing in something that is illiquid means that it should actually outperform, right? Because otherwise, why would you do it? So there should be an illiquidity premium, and indeed there is. Secondly, investing through really good or great PE firms does enhance the value equation. So I showed you before on that previous slide how the top quartile really outperforms the bottom quartile. Well, if you can get into those top quartile managers, they invariably add a lot of value to their investments. And that's why you can see this extra performance combined with the leverage in businesses means that you can really create a lot of value. Thirdly, there are these overt listing costs. Now, I'm talking about global. I'm not talking about Australian private equity, which I think has its own dynamics, which are quite different to global. But in the US market, it is extraordinarily expensive to be listed. You know, the compliance costs, the legal costs, the board costs, the insurance costs, et cetera, et cetera. So when you're operating in a private context, you obviously don't have to have all those costs. And then there's the hidden costs of investing in listed equities. So these hidden costs are really driven by the fact that in the listed markets, you need to do things like have quarterly reporting. Can you imagine running a business based upon your next quarter? So you're forced to do things in your business that really don't make sense in terms of creating value. So I think that is a real impediment to listed business, whereas if you're in a private context, you don't have to worry about that. Next thing is that these private equity businesses, certainly in the US, attract the best talents. You know, why would I go be a CEO of a public company which has got all these rules and regulations and problems, and probably my compensation is out there in the public when I can go private and get much better returns with less publicity, etc. So but it attracts the talents, and by attracting the talent, it creates additional value. And then finally, there's a real supply-demand imbalance in these offshore markets. I think most of you have probably seen these sorts of slides before that shows how these public markets are shrinking. You know, there's less than half the number of companies listed in the US today as there were 20 years ago. So what you find is that all the activity, the private markets are the flip side of this equation, obviously. And so there's a lot of demand for capital in private markets, which are growing at a rapid rate. And there really is, as I said, the supply-demand imbalance, and that provides additional value creation for investors. So let's move on to private credit and the recap of that. So what's in the private credit bucket? Now, there are a lot of activities that are in private credit. And once again, this sort of, is confusing for investors. Investors in Australia, if you say private credit, they think you're talking about property lending. In the offshore markets, that's not the case at all. Property lending is a very small part of the market. Corporate lending is really the key to the market. Almost the whole market is corporate lending. When we think about this, once again, we like the mid-market. So those companies worth maybe $500 million to a couple of $1 billion, and that's a really sweet spot in the market, and I'll explain why that's the case. So what's in the bucket? Direct lending, structured credit, specialty finance, credit opportunities, which might include things such as distressed debt, etc. What's important about this market is that it's a bilateral market, so it's a lender and a borrower. Right, this isn't going through intermediaries, etc. This is a one-on-one lend. It's exactly the same as banks would do when they're lending to a borrower. It's secured, so it's secured, if it's corporate lending, secured over the cash flows of the business, over the property, over the hard assets in the business, etc. So it's secured, and it's highly protected. It's protected by the nature of the contracts between the lender and the borrower. So that's when we think about what's in the bucket. The opportunity set is definitely a global opportunity set. Mostly it's North America, and then Europe also has quite a big market. The rest of the world is very, very small. That's why I say we don't, when we look at this, we don't go near the Australian marketplace just because it's a small part of the market and it's property, and that's quite sort of specialised, and that's not what we do. It's about a $2 trillion market, and as I said, there's a lot of diversification of strategies in this market. So the real critical thing about why this is such a good place to invest is that since the GFC, the regulators have put pressure on the banks to stop lending to corporates. They don't like the fact that the banks will have a mismatch between lending to corporates for a long term, but on the other side of their balance sheet, they have depositors who can pull their money out every day. We saw these examples of how dangerous this can be with SVB, a couple of years ago. I guess a year and a half ago. So the regulators have put pressure on the banks to pull back from corporate lending, and so there has been a real absence of capital in the market. And into this void have stepped the private credit providers. So there's a supply-demand imbalance, and this has resulted in the private credit providers being able to provide credit at much higher spreads than you would otherwise expect, and much higher spreads that is other than should be commensurate with the type of risk that you're providing. So, or the risk that you're taking. So a private lender in the US markets can lend to a safe and secure billion-dollar company with, say, a 35% LVR. So this is all kind of bank stuff, what a bank would do in Australia. And they can do this at a spread of 550 to even 600 basis points over the prime rate. If it was a bank who was doing that, maybe it's a couple of hundred points at best. So there's a massive spread differential. And you can imagine the risk associated with lending to a safe and secure company at a relatively modest LVR with a billion-dollar type valuation is really good because, billion-dollar companies don't fall over. So the experience in these private credit markets has been absolutely fantastic. In fact, if you look at the better managers, the loss rates are close to zero, certainly, less than 50 basis points. Maybe they're like 20 basis points. So, fantastic high single-digit, sometimes even double-digit returns with really low loss rates. It's a fantastic asset class. Let's talk about implementation. So there are challenges. So I've told you all the good stuff. This is a fantastic place to invest. Private equity, private credit, double-digit returns or high single-digit returns, low volatility. Why isn't everybody getting into this? Why don't all your clients have this in their portfolio? Well, it's quite difficult. So the first thing that's difficult is manager selection. How do you find those best managers in the marketplace? I showed you that, first quartile versus bottom quartile. You don't want to be with the bottom quartile. It's not a great investment. If you can be with the top quartile, that's fantastic. But how do you know who they are? These aren't public markets. The information is scant. You have to find somebody or somebody to invest with that can identify and due diligence these managers. So that's the first thing. The second thing is that even if you identify these managers, you might not be able to get them to take your money because the best managers have lots of people queuing up to give them money. So that's an issue. Third issue is capital efficiency. Now, this is something that I think is a bit misleading and really hurts investors over time. So you'll often see that with private equity funds or private equity investments, there's an IRR quoted. But the IRR is quoted on the money that you've actually given the manager or the fund, etc. But they do this on a capital call basis. So they'll say to you, you want to invest $1 million with us? Fantastic. Give us $100,000, keep the other $900,000 in the bank, and we'll call it over time. Now, when they report their IRRs, they're reporting it on the $100,000 and growing 200, 300 until they've pulled the full $1 million out, and then they have it for a period of time, etc. That looks fantastic. But you as the investor have kept $900,000 in the bank earning 4% or whatever you can get in the bank. And they can call this from you usually with 7 days notice. So your IRR on your total $1 million is not that great, even though the managers are reporting a fantastic IRR. So this is something really to watch out for. And we have the saying in this end of the industry that you can't eat an IRR, and that's absolutely the case. So other issues with capital efficiency is FX risk. So with global private equity, private credit, you're in these global markets, you US or Euro denominated. A lot of investors don't want to take that FX risk. So unless you actually are able to invest in vehicles that handle the currency themselves, you've got that currency mismatch. Another thing with capital efficiency is once you get invested with these funds or these managers and you've got your full $1 million with them, the last thing in the world you want is for them to give you the money back. Because they give you the money back, you've then got to get reinvested. So you actually want them to keep it for as long as possible, or you want to be in a vehicle that's a more evergreen type vehicle that just continues to invest. So you never get the money actually returned to you and have to actually find a way to reinvest it. You want the manager to do that in the vehicle. Diversification diversification is absolutely key. I said that these asset classes are fantastic. If you can get the top quartile managers, you'll do really well. You do not have to pick the single best manager. Go for diversification. You'll cover yourself really well with diversification. Everybody can have accidents, even the best managers. Diversify, diversify. And finally, flexibility. This has always been a problem with private equity and private credit to some extent as well, is that you need to lock up your capital with a lot of structures. If you lock up your capital, something else comes along, or you've got a reason why you need to access this capital, that won't be available. Or it's only available with a massive discount. So that's another issue to watch out for. So solutions. Fortunately, there are now solutions in the marketplace, and I think good solutions, not just the Pengana solutions, although those definitely form part of it. You now, as a regular investor, can invest in the types of things that only the big end of town could invest in previously. So the solutions, with each of these solutions, it's critical that they're structured specifically for the type of investor that wants them. So some investors can cope with longer lockups. Some investors need daily liquidity. There's absolutely an inverse correlation between return and longevity of the investment, or lack of liquidity in investment. So you need to have a trade-off there, and it's important that the vehicle that you construct is done with that in mind, etc. So some of the ways to invest, there are listed vehicles. Listed vehicles are great because you've got 100% liquidity on a day-to-day basis. We've also, in our business, and I think some others have as well, although not in the global private equity side, have created SMA solutions, and those are quite different and specific solutions. And then there's also retail unit trust products there, which usually have like a quarterly redemption mechanism, or what they call in the US an interval fund structure, where you can pull out your money on a quarterly basis subject to some potential gates if there's too much redemption. So that's some of the solutions that are out there. The publicly listed vehicles are really interesting. I think this is the ultimate way to invest in private equity and private credit. And why do I say that? Well, from an investment perspective, if the investment manager does not need to worry about liquidity, then they can invest the money in the best way possible. The moment you need to worry about liquidity, you're forced to make some compromises about how you invest. So if you're in a listed vehicle, there's no access for investors to actually get a redemption, so you can invest in the ultimate way possible. There's no liquidity mismatch because of that. You don't need to invest. You won't have capital calls. You can go straight into the vehicle. You can remain invested perpetually, so nobody's giving you your money back. You can rebalance or etc. straight away. And then also what we found with some investors, they complement a listed exposure with an unlisted exposure because they're quite sort of different. The unlisted exposures, there's quarterly redemption with a potential gate, and the listed exposure is daily liquid but can potentially trade at a discount. So they match those two up to create a more diversified portfolio. So the critical thing with listed vehicles is eliminating the discount to NAV. So we all know this issue. You can see it across the market now. The market now is becoming a lot more sophisticated when it comes to listed vehicles and dealing with discounts to NAV. I think we at Pengana, we like to take some of the credit for this. A year ago, we launched a listed private credit vehicle, PCX, and in that we put a mechanism that is built to ensure that the product trades at or above the NAV, and that's worked quite well. And basically, what that product does is what the mechanism does is it includes a quarterly redemption mechanism within a listed vehicle. So, as an investor, I can get out one of two ways. I can sell my stock on market, or alternatively, I can put it in a quarterly redemption notice. And what ends up happening is that investors don't want to sell at less than NAV on market, because otherwise they would put in a redemption notice. So you find that it trades always at or above the NAV. So I think, and some of our competitors have now launched vehicles and are using that structure as well. So I think that's a good development for the market, and I think you'll see more of these things happening. We actually have our listed private equity vehicle, PE1, which currently trades at a big discount, and we actually announced that recently to the market that we're putting in some sort of mechanism. We haven't explained what the mechanism is, but some sort of mechanism that will also, take into account the closure of the gap. And I think it's really important that vehicles do this going forward. So using private market strategies in your portfolios, I think this is the most fascinating topic in private markets. So usually people talk about it in the alternatives bucket, but I think that there's so much better applications than that, and that is to use your private equity in your equities bucket and your private credit in your credit bucket. So why would you use it in your equities bucket? Well, as I said, you get higher returns with lower volatility. That's really good for portfolios. Depends how you're managing your portfolio. If you're trying to hug the index, obviously you can diverge a lot at short periods of time. But if you're trying to reduce risk, increase returns, and you're happy to vary from the index from time to time, it's a slam dunk opportunity in your private equity portfolio. Your private credit portfolio, your fixed income portfolio, you can use your private credit there. Think about this private credit. You can be earning high single, low double-digit returns in your private credit portfolio compared to what you can earn in bonds, other fixed income instruments. This is actually, I would say free money, but it's close to free money as you can get. I'll tell you a little bit of a secret about the super funds at the moment. All of the super funds are trying to figure out how they can use more and more private credit in their fixed income portfolios. The super funds have these tests that the government's given them, that they have to beat the index or match the index or the benchmark within these various buckets. This is free money for them because they can put into this, it lowers the risk, it highes the return in the portfolio, and they can smash that fixed income benchmark. So this is really, really interesting stuff when you think about these asset classes. Once again, if you want to use these in your private equity or private credit, or in your equities or fixed income portfolios, I'd suggest you want a lot of diversification because you don't want to take individual risks in this. So some critical questions. The first one is, obviously, do you have enough of this stuff in your portfolio, private credit and private equity? If you do the maths on it and you do an efficient frontier and it was unconstrained, your efficient frontier would tell you put 100% of your money into this. Now, I'm not saying that you should do this, but I think in thinking about building your portfolios, people should actually consider the raw maths of it all and figure out, really what might be the best thing, especially for investors who are willing to take those types of, dynamics in their portfolio. So, secondly, have you got enough of the good stuff, right? So I think there's a lot of stuff out in the market. There's a lot of, as I said, we think about the good stuff as, mid-market, global private equity, global private credit, and there's lots of other good asset classes in these categories, right? And good managers, etc. And then there's a lot of stuff which actually isn't so good. So, hopefully I'm not offending anybody in the room, but like the traded credit markets, which sometimes they're products which pass themselves off as private credit, but they're really just liquid traded credit with volatility, etc. So look hard at the underlying structures in your portfolio. Not everything private equity, not everything private credit is actually good. Do you have significant diversification? I've mentioned this a whole bunch of times. You want diversification across managers, across sectors, across geographies, across vintages. Diversify, diversify, diversify. If you get enough diversification and you're able to do this top quartile investing, it's a fantastic low-risk asset class. Capital call structures, as I said, some investors, it can work for them. Most regular type investors really hate this and they can't deal with it. I spoke about that. You've got to keep $90 in the bank while the manager calls it down. If you're a super fund, that's actually fine because there's a lot of money coming in and out and you're investing, etc. For regular investors, it's usually not fine. We spoke about whether your fund has a liquidity mismatch. There are structures out there that have very large, blatant liquidity mismatches. Doesn't mean that they're bad products, but I think that we should really consider that in the context of the underlying portfolio. And finally, how does the illiquidity or liquidity of the various ways of investing, how does that fit into your portfolio? So some investors we found are happy to take some illiquid assets in their portfolios because 70% of their portfolio might be in listed equities or bonds, etc. So with 30% you can take the illiquidity. Some investors don't want it at all. And so there's various ways and means of investing according to the preferences or the outcomes that investors are trying to achieve. So those are some of the critical questions. So just finishing off, my key takeaways from this. In our view, global mid-market investing in private equity and private credit is an unbeatable asset class. Build diversification into the portfolios. Get invested and stay invested. Don't be in and out of this asset class. And then finally, think about allocating to your equity and fixed income pieces of your portfolio, and not just your alternatives markets. I think good for timing. I'll stop then. Fantastic.
Stay up there, Russell. Any immediate questions for Russell on presentation before we pass it over? Just a quick question from me. You spoke about just the growth in private credit and the really attractive spreads. Have we seen any compression on those spreads, and do we expect those to be that attractive moving forward?
Yes. So in global markets, global mid-market private credit, there has not been any compression, and I think there's still a supply-demand imbalance, and I think that's actually not getting any better over the next 5 or 10 years. So I don't think for the foreseeable future, we don't think there will be a compression.
And Russell will be joining us for the panel session at the back end of this.